Hello everyone, my name is Tze Kang, the expert tutor for AFM. In this topic explainer, I will talk about risk management with futures contract part 1, marking to market. In this part of the video, marking to market, in short, MTM, will be made refers to the following ACCA learning resources for your further understanding. First and foremost, in the study hub, which you may refer to chapter 14 and 15, in particular section 14.3.4. Guys, once you get into the study hub, referring to the chapter on the left-hand side of the tab, you will find the two of these chapters towards the end of it. Referring to chapter 14, once you click it in, you will be able to see the following series of the subsections on the content. What you have to do, it is to just get into 14.3 section and go into item 4. So once you get into that, you will be getting and seeing a more detailed explanations regarding currency futures contract, the margining system, more importantly, the explanations about marking to market. Last but not least, other than the study hub, the following series of the references from the ACCA website are also made available, namely the technical articles with the title Exchange Traded Foreign Exchange Derivatives and ranges of past examinations questions that found on the practice platform should be highly practiced with the aim to get yourself more familiarized with marking to market. In this video, I will take you through, first and foremost, to get a basic understanding on how futures contract works for hedging purpose. Guys, the part of this video is mainly focusing on the processes of marking to market, while the way to create the hedge with the futures contract would be in a way an assumed knowledge for most of you before watching this video. So, first and foremost, you need to be aware that whenever the questions is coming with a task that mentioning a company is about to experience some transactions in the future that would expose to risk. So how are we to trade on the futures contract for hedging purpose? Before we get into more details, it is common and it is essential for students to get aware how are we getting ready to trade on the futures contract being one of the exchange traded derivatives that are available in the derivative market? Well, here are the two basic requirements. Firms or businesses that is more commonly referred as the hedger would require to create and open up a trading or a margin account with a brokerage firm that is acting as the intermediaries to act on behalf of clients such as the hedger to trade onto the derivative market. Secondly, it is a requirement to place certain amount of sum by the named initial deposit of margin into the particular margin account before any trading instructions can be created. Once the trading account is created, then this is where the story of the examinations starts for hedging purpose. In order to create the hedge position with the use of futures contract, whether it is for currency futures or 3 months interest rate futures, it is important to understand the account holder, which is in this case the hedger, will need to instruct the broker on the brokerage house to enter a trade or create a trade order, which is either refers to a buying instruction or we call long. Alternatively, the hedger will need to tell the broker to enter into a sell instruction, or it is called short position. How do we estimate? How do we decide to buy or to sell? The underlying principles underpinned in such motive, it is to firstly anticipate what it's the anticipations of the adverse movements in the prices of a particular underlying asset. So in other words, what exactly is the directions of the change in the price that make you suffer from losses. With these anticipations on the adverse movement in the price, that is how the creations of the hedging positions with futures contract commence. So what the hedger would need to inform the broker, it is to buy or to sell, as we have mentioned a while ago, either a currency future if the aim is to manage foreign exchange risk arising from ranges of foreign currency transaction that to be settled in the near future. Alternatively, to buy or to sell a 3-month interest rate futures, which cater for managing interest rate risk arising from a planned borrowing or deposit in the near future for certain periods of months. When this trade order is executed, it will be traded at the price of that particular futures contract at this point, which is what we call now, and the date of now it's usually given and stated clearly in exam. At this point, let's refer as P1, and let's not forgetting to indicate clearly in your answer about the number of contracts on the futures that you are to trade for at this moment. So this is how the hedge is being created. So what's next, guys? When the futures contracts positions is now open or created, here comes the next stage. In between now, up to the timing where the underlying transactions take place, there will be regular and continuous fluctuation and changes on P1. So it is common that by the end of every trading day, as long as the futures contract positions still remain open, it is the regulations for the derivative market to undergo a process by the name mark-to-market to determine the closing positions of all the tradings of the futures contract in each and every of the accounts holder particular. To determine if there is a need, a variation margin would be called for the hedger to place additional fund into the account to make up the unrealized losses position. So how exactly these will be carried out? And the answer will be shown in the following detailed explanation. While the futures contract positions remain open, the mark-to-market processes, as we have mentioned, will carry on and take place at the end of the closing time of each trading day. So what the derivative market would do, it is to take the price on the day when the futures contract is bought or sold, which mentioned earlier, P1, comparing to the closing price of the futures contract at the end of that day, which is called as settlement price. And each and every other trading days, as long as the futures contract's positions still remain open, the closing price of the day will be becoming the opening price of every subsequent day. So end of that subsequent day, same comparisons will be made. So conclusion, at the end of every closing point of the trading days, when the price that you can see over here, it's different from the closing price. The differences that found at the end of every trading day will give rise to either a gain or a loss in the futures contract position. Should gain is anticipated, this gain will increase the balance in the trading or the margin accounts of the accounts holder, which is the hedger. Vice versa, should losses is resulted from the comparisons of the prices at the end of each trading days, these loss will then reduces the balance in the trading accounts or the margin accounts of the accounts holder. Guys, when the fluctuations of balances in these accounts is found, what happens if the balance is exceeding the maintenance margin level, which is obviously the minimum balances that must be kept in the account? Well, when these balances exceeded the maintenance margin, the account holder, to be more precise, the hedger, may allow to withdraw the excess for some other users. Otherwise, all the money or all the amount that found in the account balances, including all the additional deposits, or we call variation margin, that deposited in the account, will allow to make some additional return, which is the interest. Alternatively, if the balance falls below the maintenance margin level, what happens? The hedger or the account holder would then require to place additional fund that equals to the variation margin. That is the size of the fund that the account holder or the hedger would have to chip in to ensure that closing balance of the margin account is at least meeting the maintenance margin level. That is the whole processes of what we call mark to market. These processes will carry on up to the later date when the underlying transactions finally took place, either referring to the foreign currency transactions, either the actual payment or actual receipt in foreign currency will have materialized. Alternatively, for interest rate, either the borrowing or the depositing start taking place. That is the point that the hedger would need to create and enter into a reverse trade order, which is named as the closeout transaction, regardless of the outcome of prices of that particular underlying asset. Once a reverse trade order is created, differences will arise from the price of that trade. In other words, it will be traded at a price which is different from P1. That is where the following positions will take place on the later part of the day. When the futures contract position is closed, this is where the transactions take place. If at the beginning of the period, say, the hedger were to buy the futures contract, later on, to close out, the hedger would then sell. The reverse is true. When it's sold at the start, it then becomes buy later. So you would then sell the currency futures or the 3 months interest rate futures which applicable at the price of the futures contract that is now becoming P2. And same number of contract will be entered for closing out moved. With the difference between the P2 and P1, these differences will give rise to the gain or loss from the trading of the futures contract. These gain or loss were then used to offset the loss or the gain arising from the fluctuations in the price of the underlying asset from now until the physical transactions take place at a later point. So as a result of the netting off or the offsetting effect, this offsetting effect is therefore providing a controlling effect, and this is the summary of the head of the result using futures contract, which is to minimize the net gain or loss from the transaction. That net gain or loss that would kept minimum would therefore seen as the effort of reducing the volatility or the uncertainty from the fluctuations in the prices of the underlying asset. That is the main intentions of making use of futures contract for hedging. Guys, once again, the purpose of this video is not aimed to show the creations of the futures contract, whether to buy or to sell, but the focus is placed onto the processes on mark to market. As such, the following descriptions on MTM, mark to market, that extracted from the study hub would best explain the meaning in simples on the processes that I have explained a while ago. To demonstrate the process of the mark to market, the following example, which is from a past examinations questions, is referred to. Here we go. We are mainly focusing on part C of the requirements that is asked to calculate and explain the impact of open futures position on the cash flow positions of B company denominated in US dollar. And guys, from the explanations a while ago, to demonstrate the impact of the futures positions that remain open, it have to all start with the creations of the hedge for meeting the risk management objective of the firm that was required and asked in part B regarding hedging against the risks arising from foreign currency receipts that is arising in 6 months' time. In order to understand how the calculations for part C is demonstrated, you would then just spend time to go through informations on the following questions, which is B company, Poland company, that is located at Eurozone. And assuming the date today is on 1st of March, year 20X0. This company is expecting to receive an amount of 18.6 million US dollar. Take note, the US dollar is obviously the foreign currency to B company. And these receipts will be expecting on the end, the 31st August on the same year. That is what the director is concerning, which is to minimize the exposures of the companies by using and considering ranges of hedging instruments. Among all, exchange traded futures is one of it. Let's keep the focus onto these instruments. But guys, you are highly recommended to spend time to go through and attempt these questions in full to have a better understanding on how to deal with the questions in managing the foreign exchange risk questions. Let's get back to the information on the currency futures. These are the market data. The price of the futures contract quoted on 1st of March for 3 batches of futures contract that expired on March, June, and September respectively. Well, guys, you should know, given the date of the settlements for the futures receipts that will take place at the end of August, September futures contract that remain valid by then can only be used instead of March and June. Therefore, when you attempt part B of the questions in creating the hedging positions for managing the risk, that is what you should be able to create in your answer. For hedging, based upon the September futures, the way that the futures contract is priced, and also the foreign currency denominated in the transaction, the company should therefore buy the September dollar per euro futures contract for 81 contracts. Guys, try to spend some time to figure out the trading instructions as well as the number of contracts by referring to other parts of the content in the study hub. What is of more important here is that the buying of the futures contract today will be traded at the price given in the questions, $1.1422 per euro. And bear in mind, when the hedging positions in part B is created, coming to part C, you are required to understand in order to demonstrate the impact on the US dollar cash flows while the futures positions remain open. Remember, a while ago, we have mentioned the steps and the rules required, like opening up the accounts and placements of initial deposit will be required for trading on the futures contract. So in order to answer part C, you need to refer to the further part of the information in the questions regarding margin information. These paragraphs tells the mark-to-market processes in this company or in this market will be taking place on daily basis. And it is required for all the traders, including the hedger, such as the B company, to place an initial deposit of $3,500 per contract with the clearinghouse. At the same time, maintenance margin level is set same as the amount of initial margin. So with these informations given, the manager of this company B, it's now concerning how the impact of the future positions that remain open will affect the cash flow of the company, and therefore you're required to demonstrate the calculations showing the impact on the cash flow. And therefore, you are asked to explain how would these changes be affecting the positions based upon the following settlement prices given at the end of the first 3 trading days when the futures contract is created. Namely, these are the price of the futures contract ended for September futures at the end of 1st March, 2nd March, and 3rd March. To demonstrate the mark-to-market, I would demonstrate what happened on 1st March. You are required, after watching the video, give a try to work out the answer on the mark-to-market processes on 2nd March and 3rd March. So, what happens on 1st March when the futures contract is to be bought? It requires the trader, which is the B company, to create an account on the margin account. And to do so, it requires an initial deposit as discussed and referring to the information provided by the exam questions, which is based upon $3,500 per contract. For 81 contracts to be traded, that gives rise to $283,500 in total of the initial margin to be deposited on 1st of March before the trading instructions could be given to the broker. And bearing in mind, this amount of initial margin is also reflecting the maintenance margin as described by the questions. Once this deposit has been placed into the account, that's when the trading instructions start taking place. By the end of 1st March, the questions has mentioned the settlement price or the closing price of the futures contract is recorded at 1.141, which is there it goes. By comparing the price of the futures contract we bought at the early time on 1st March, we bought at 1.1422, but later the price has declined. It's clearly that we were bought at a higher price, the overpayment of the purchase price by $0.0012 per euro. It's therefore representing we overpay for it, and that is referring to the loss. Vice versa, if the closing or the settlement price ended up higher, we bought at the cheaper price, and the difference is the gain. The same mindset will be used to determine loss or gain position by comparing the opening price on the 2nd day that is based on the closing price of the 1st day on March. These will become the opening price on 2nd March comparing to the closing price of the 2nd March to make use of the same mindset to determine whether the ending positions at the end of 2nd March would then give rise to loss or gain. These losses will then be used to calculate the total amount of loss that's shown in the accounts of the hedger. So therefore, $0.0012 per euro will then multiply with the contract size that made up of 200,000 euro per contract and multiply 81 contracts in total for trade. These give rise to the total losses of 19.44 thousand. As mentioned earlier, these losses will then reduce the balance in the trading or the margin account from 283.5 thousand to now 264.06 thousand. Guys, when the balance falls below the maintenance margin, that is when the variation margin will require to be deposited into the margin account by the hedger. And the amount of the variation margin is exactly the same as the amount of the loss suffered. So once the variation margin is deposited into the account, the account balance would be able to restore to 283.5 thousand ultimately. Well, that is how the mark-to-market processes will ensure the account's positions is still remain valid and it still remain open until the future transactions take place. With this explanation, I hope you will get a better understanding and the concepts regarding the mark-to-market processes. With that, take care and good luck in your examinations to come.